Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer some of the Ask James questions of the day. Our first question today from Caleb. I understand that 4% is a safe withdrawal rate, so I should be okay if I only take out 4% or even less than that per year. Hey, this is a great question. I hear this often. And I think you're getting right to the heart of the matter, what a lot of people are thinking, right? It's been published so many places how there's a safe withdrawal rate. And it's a concept that's gotten a lot of attention, especially as more baby boomers enter retirement. A couple of things I would contend here. First of all, is that it seems as though nobody can agree on what the safe withdrawal rate really is. It was 5%. Went to 4%. And then sometime around the pandemic, it was down to 2.7, 2.8%, which means that if you have $1 million, you can only take $27,000 or $28,000 a year. Now, recently with higher interest rates, it went back to 4%, but very recently now, Morningstar came out with a study that said it's really 3.7. So again, that means that your income during retirement is going to have to go up, it's going to have to go down, because the safe withdrawal rate really does change. And this variability alone should give us pause about relying too heavily on this approach. That's number one. Now, number two is the fact that, what is safe? Does safe mean that you're not going to outlive your money for sure? No. Safe means that there's a high probability you won't outlive your money, but there's still a chance that you will. And in retirement planning, we need to think very carefully about what level of risk we're really comfortable with. So Caleb, think about this. In mathematics, there's something called Monte Carlo analysis, which it really goes beyond what most of these studies that most advisors use. And for most advisors though, if you get to a 90% success rate, they consider that to be a success. So there's a 90% chance that you withdraw money, and historically speaking, you do not run out of money during retirement because the money happens to continue to grow and you're in a bull market, or because you die early. Either way, then you're part of that 90% that had success. But that means that 10%, there's a 10% chance that you'll outlive your money. And whether it's because you live beyond average life expectancy or because maybe the markets don't cooperate, this is particularly concerning given that people are living longer than ever. And market volatility seems to be increasing. So it's great for some financial advisors to say, that, hey, there's a 90% chance of certainty, that's good enough for me. But that means that when you go to one of those client appreciation events or parties that advisor might throw, and you go around and there's 10 people sitting at a table, you have to look at each table. One of them is going to run out of money. And when you get to your table, you have to wonder, I wonder if that one person is going to be me, right? So again, I don't think 90% is a good number, if it's my money or if it's your money, right? Instead, what we really should be focusing on is building a portfolio that generates reliable income through dividends, interest, other income-producing investments. This way, you're not relying on mathematical probabilities, you're creating actual cash flow that you can count on. When you build your retirement strategy around income-producing investments, you're not playing the probability game with your future. So I would say no. 4% is not truly a safe withdrawal rate. In fact, I'd encourage you to shift your thinking away from withdrawal rates altogether and instead focus on building an income-producing portfolio that can support your retirement needs without requiring you to sell assets or worry about market timing. Caleb, really, this is exactly the kind of conversational wisdom that needs to be challenged, right, when planning for a secure retirement. So thanks for the awesome question. And if you would like to send in your question like Caleb did, you can do so by emailing it to poollocke at poolelock.com. Moving on to our second question today, and this is from Cheryl, and she asks, what kind of investments do you use to invest for income? Specifically, what kind of instruments do you use? We get this question a lot, and Cheryl, the interesting answer is all the instruments that you use are very similar to the instruments that you've used your entire life during your accumulation years, when you were growing your assets. But the difference is now, instead of those that have a small income component that you buy, mostly for the G, for the growth or capital appreciation, you're now getting a higher income component, right? And this shift in focus is absolutely crucial for retirement success. So the key is to focus on that equation. Total return equals income plus growth. TR equals I plus G. This fundamental equation guides everything we do in retirement income planning. So you can buy stocks that are just growth oriented, that they don't pay any income, any dividend. Or you can buy stocks that pay a dividend and have some growth potential. And when we're talking about dividend stocks, we're particularly interested in companies with long histories of not just paying, but actually increasing their dividends over time. Now you can buy bonds, what's called a zero coupon bond at a certain price. And they increase in value as they get closer to maturity. Or you can buy bonds that pay an actual interest payment. So you can buy bonds in a G way, or you can buy bonds in an I way. With today's higher interest rates, bonds are becoming an increasingly attractive option for income-focused investors. Real estate, I've been using that analogy for a long time, whether you're doing it yourself or you're doing it through real estate investment trusts, REITs, either way, you can buy real estate that, they're primarily for the G, for growth, in the hopes of capital appreciation, or you can buy something that also provides income. Now, REITs in particular can be an excellent source of steady income since they're required by law to distribute 90% of their taxable income to shareholders. In fact, if you think about it, pretty much everything that you buy can be done in a G way or an I way. You can buy commodities, right? Gold, silver, copper, soybeans, you name it. And they're typically growth investments, right? But you can also write calls on the futures market against it. And you can engineer it into an I creation where it actually generates income on a regular basis. Though I should note that those are more sophisticated strategies and should only be implemented with proper understanding and risk management, right? Heck, even Bitcoin, right? Cryptocurrency, you can buy Bitcoin. You could stake your Bitcoin and get some interest from it. Get some payments from it. Though again, I would caution that crypto assets should generally make up only a very small portion of any retirement income portfolio due to their volatility. But it doesn't matter. The bottom line is anything you can do can be done in an I way or a G way. So it's more about changing your focus and paying attention to how much of that total return comes from the G, the growth, or the I, the income. The key is building a diversified portfolio of these income-producing investments that can provide reliable cash flow throughout your retirement years while still maintaining enough growth potential to help protect against inflation. The beauty of this approach is that when properly structured, these income-producing investments can work together to create multiple streams of income, helping to reduce your overall risk while providing the steady cash flow you need in retirement. Cheryl, building an income-focused portfolio is one of the most important steps in creating a secure retirement. Cheryl, great question. Thanks for sending it in. If you would like to send in your question, you can do so by emailing it to poolelock@poolelock.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. See you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank,